Welcome to the Property Investing Roadmap Podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions, but then make a very quick decision. And they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build, and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Welcome back to another episode of the Property Investing Roadmap Podcast. Today we're going to be talking about 3 really important rules to know before investing in property. I'm delighted to be joined today by Robin Ram, who's Head of Property Advisory at Momentum Wealth. Welcome, Robin.
Thank you, Damian.
Glad to have you here. Now, just tell us a bit about your background in real estate and then what you've done in real estate before you came to Momentum Wealth, and then we'll talk a bit about what you do at Momentum Wealth. So tell us your property journey.
Well, I started very young at 18 years of age, doing pretty much everything property management, everything sales, a lot of runaround work, and it gave me a really good foundation for all things property. Over that journey, I ended up getting my license, starting my own real estate company, working for a large franchise group for a while, part of a succession plan for a business. So there's lots of different things that I was involved in, which was really from the outset of beginning stage property management and sales right through to running my own agency and running and managing a team.
And then you did some training for a while, and then you joined us at Momentum Wealth a couple of years ago now. It's gone very quickly. And tell us about property advisory. What does that division do, and what do you do with the team?
So my role here is to expand our offering to our clients. So basically, the more things we can do to eliminate risk for our clients, to present them opportunities, to advance their position with what they want to achieve from property is fundamentally my aim. And we're finding that there's, based on current market conditions, as well as more information associated with what buyers agency do, the demand for what we do is starting to increase quite significantly.
Look, over that journey, you've worked on the sales side, or the dark side as I jokingly call it, to my selling agent friends. You come to the buy side. What really appeals to you about working on the buy side versus the sales side?
I was trained, I believe, quite well with one of the franchise groups on how to maximize a position for my clients. And my client was a selling agent. So how we position the marketing, how we position the home opens, how we did the negotiation, what we did with the contract, everything was there to gear our clients, and rightfully so. They're the ones who do pay us for the service to get them the best position. But what I found in that is it presented a bit of a conflict of interest. There were lovely buyers coming through wanting to buy a property who thought I was on their side, but realistically, even though I'm there to help them, I'm there to achieve a result for my client. So I found that conflict of interest and my job and requirement to make someone pay the most and get the property sold contradicted with helping someone achieve the best outcomes for themselves in what they're trying to buy for a home or an investment.
And that's the real challenge, isn't it? Look, sales agents do a great job, and we need them, and we use them when we're selling properties, absolutely. But I think a lot of people don't understand that. They think the sales agent is there to help them. Or, local agent, he's going to call me when one comes up for me perfectly. Well, no, he's trying to get the best price, or she's trying to get the best price for the seller, and that's ultimately their legal obligation, is to get the best price and terms and work in the best interests of the seller as agent. And I think people don't understand that, and that's why we have seen certainly a rise around the country of people wanting buyers agents, not only because they're time poor, but they want someone to represent them. Is that what you're finding when you talk to clients?
They're wanting to be having someone in their corner. They're wanting someone to attend the home opens, to be advising of what we like, what we don't like, what should we be looking at for an investment property. And also, and I guess the best way I could summarize this, I went through a full presentation with a client about what we do, how we do everything, and he goes, "That was excellent, Robin. Can you summarize that in one sentence for me?" Which was a very challenging question, but I answered that with, "Our job here is to minimize risk and provide you safety and certainty." And I kind of feel that summarizes a buyer's agent's role in the process, to really look out for that client, to make sure that they get what they need, they get it on fair terms, and they're not in a position where, yes, you have to pay fair market value in this marketplace, but you don't have to pay above and beyond what something's worth.
And look, FOMO is one of those things we're going to cover off today, Robin, because it's so critically important that people don't get trapped in that and overpay. But we'll cover that later on. And we'll also talk about the emotional element. Even though most people who are buying an investment property are meant to be logical, it's that emotion. And that's one of the great things about buyer's agents. They can help take the emotion out of it. I'd be curious to hear your stories when we get to that section about clients. And sometimes clients maybe want to go too low, but in stronger markets, sometimes they want to overpay because they're sick of missing out. So we'll talk about that a bit later on. But look, the three things that I've put in the book, three really important things about fundamentals of property investing, and I think they're critical no matter when you're buying in your journey to understand this. And a lot of people don't. I often find they compare properties that aren't the same and analyse them in the same way. Well, they require different forms of analysis. So just tell us from your expertise and working with our team and the clients. The fundamental one is about, first one is land appreciates and buildings depreciate. So just tell us what you do and the team do when you're looking at an asset in terms of assessing the land value content, and tell us why that you think that's important.
What we're doing for our clients is we're looking at what is the underlying value of the land that they're purchasing, being mindful, as you've said, that the property building will naturally depreciate over time. What we want to do for our clients is find something that is underpinned by a strong portion of land value that will appreciate, and that's in a very well and desirable location.
Yeah. So with that, it's important, I think, to note it's not necessarily the land size, is it? It's about the land value component and the ratio of the land value to the building, because ultimately, well, land goes up, buildings go down. That's a short way of summarising land appreciates, buildings depreciate. But in 40 years, that brand new property is going to be not very flash, right? It's going to be dated, probably may not meet modern criteria, or if it is still in a structurally decent condition, may well need a lot of work to bring it up to modern standards. So that building is going to go down. But it's the land value, I guess, that's critical, isn't it? You could have a 200-metre block in a city suburb that might have more land value than a 500 or 600 metre block at 50, 60 kilometres out of the town. So tell us, when you're buying properties, do you assess that for clients? What's the imputed land value on a property?
We address within clients' budgets. We're there to present as many options as possible that meet their brief as well as will achieve their financial goals. When we're looking at certain price points, and let's say you have a segment and you want to achieve a price below 500,000, very difficult marketplace to be in. You can either go further away from CBD, further away from infrastructure, or what you can do is you can start to look for well-located, smaller properties, but as you said, are underpinned by significant portions of land. So our team has recently secured some excellent sites within 5 kilometres of Perth CBD. One quite recently was 10 apartments, probably built about 25 years old, sitting on a corner location in a suburb called South Perth on about 2,500 square metres. So when you're looking at something like that, the underlying land portion is still significantly better than buying something much further out. We're also then hopefully getting a better quality of tenant moving to that property, as well as a lower turnover rate of tenants because they're in an area they want to stay in. And if they do decide to leave, there'll be another tenant who wants that location and that area to be in. So we're finding less volatility in tenant turnover as well as quality tenants. Yeah.
I think there's two critical points there. It's about the quality of the tenant, which is important. Long-term stays, people look after the property, because that's where a lot of the headaches are. We find in investing in property that people give them, and often people leave and sell their properties because of the tenant headaches. And we'll talk more about property management in other episodes. But the other thing you mentioned, I think, is really critical as well, is that apartments can still have a good imputed land value content. So even though they don't have necessarily their own block of land in their own private courtyard, they're buying a share of the overall block, which is the one you mentioned before. So it's just critical. I think the point of that is to get to the listeners is that when you're buying a property, you've got to be thinking about the underlying land value. And if you're buying a property for, say, $700,000 and the imputed land value might be $100,000, or in some of the CBD apartments, perhaps it might be $50,000 or $60,000, your capital growth is going to be lower. That's just a fact, because the building depreciates, so you've got the building going down in value, that part of it. The land's got to keep up and surpass that. So yeah, you might get different investment returns. You might get better depreciation benefits. You might get maybe even better rental yields potentially on some of those properties, but you're likely to get less capital growth. So I think that's what we want people to understand. You can't compare a CBD unit at $700,000 and say, oh, that's, and that gives you a little bit better rental yield versus, say, a property 5 or 6 kilometres from the city on 300 or 400 metres. They're not the same assets. You're not going to get that house might give you less rental return. You can't say, well, the apartment's better, because reality is that the one with the better land value is likely to grow more in value, isn't it?
That's right. And you're also having better holding costs. Some of those apartment complexes where you've got over 3 stories, you've got elevators, you've got gyms, pools, they attribute to your holding costs, and you're paying for that, and that affects your yield and your return.
It's a great point, Robin. Now, look, we're going to go into the second fundamental rule, and that's look for areas of high demand but limited supply. And certainly over my investing journey, I've noticed many developers and agents promote out of suburban areas as growth corridors, and they say, well, look, this area is growing in population by X% per annum, and versus established areas not growing in population at all. And fundamentally, they're using that as a sales benefit. Well, there's all these people coming here, and it's growing. That's good. It must mean there's good demand. Well, it does, but that's because there's lots of supply. We look at established areas and go, well, there's not a lot of growth in the population, not because there's not strong demand and lots of people don't want to live there. There's just not enough supply. And I think it's a critical thing, that finding areas in good demand but limited supply. So, Robin, just tell me some of the things that you and the team do when you're looking for investment properties, how you assess that strong demand, what is driving people to particular areas.
The point you mentioned with the outer-lying areas and the high demand for those areas being core growth areas, completely agree. But the growth areas, because of how much is being built around that, how much house and land packages maybe are coming up for sale in that next 6 months to 5 year window. But also when you follow like what we spoke a bit about earlier on the selling agent side of it, the selling agent is paid by the seller to get a result. When you're looking at these house and land packages or these newer builds on outer-lying suburbs of Perth, you're looking at what is the vested interest of the party trying to sell it, and they're getting paid for that. So where we differentiate ourselves at Momentum Wealth is primarily we don't want to be incentivized by anyone else except for the client to work in their best interest. And when someone's putting money on the table and saying, buy this here because of this reason, does that stack up? Is that someone that's truly working in your best interest? And quite often, even though they may be lovely to deal with, they're still working for someone, and ultimately it may be that builder or that referral partner that they're choosing to work with. When we're looking at outer-lying areas, and I draw back on my sales experience, in about 2016, I was approached by one of my clients, wanted to sell their investment property. They happened to want to sell an investment property on an outer-lying area of Perth. When I looked at the property and the price point, at that point in time in 2016, you could have bought a family home in this suburb for about $450,000 to $500,000. I quickly looked online and I said, no worries at all, very happy to help you. I'd love to help you sell your property, of course. But just so you know, there's currently over 400 4x2s on the market in your suburb. And this isn't in Perth at that particular time, 2016. It wasn't a very busy marketplace. So if there were about 10 to 20 buyers active in that suburb to purchase a home and they've got 400 to choose from, how are you as a seller going to stand out and get a great result for your client? Not only did we have to compete with those 400 houses for sale, but we also had to compete with the builders who were offering house and land packages with first home buyers grant, trying to attract the established market into their product as well. So that presents an underlying risk. When we look with our clients, we're looking, and this is often used in a presentation when I go through a client, say, look, this is some of the things that we'd want you to look at, is beginning with the end in mind. So your end is a very popular property to sell in 10 years, 20 years, 30 years time. What's going to drive people to pay top dollar when you sell that property in the future, not just right now and not just a reaction to what's happening today in the marketplace. And we find that if you plan ahead for 10, 20, 30 years time, that's where you can really set yourself apart from the rest and focus on those areas that don't have the new supply coming on, don't have a similar amount of products, are positioned too far away to attract a stronger demand in the future.
So tell me about some of those things you look for high demand. Is it infrastructure? Is it roads? Is it trains? Is it proximity to water? Tell me about some of the things that you look at as a team, and to choose areas you think that are going to have and continue to have, not just now, but we're looking in the future, continue to have high demand.
Yeah, different capital cities have different drivers. And when we're looking at, and I'll use Perth as an example, Perth, its convenience is key. So if we're able to look for properties in areas that are going to meet the demands of the first home buyer, the investor, the downsizer, the upgrader, we're going to have a marketplace that we can work with in the future to get that property sold. We're looking at proximity to train stations. Anyone who's been to Perth 5 years ago compared to Perth now, traffic is becoming more and more considerable. People are looking, how can I have the quality of life? How can I go to cafes on the weekend, walk to the shops? How can I catch a train to work? How can I minimize the work-related time that I might have to be and now have more quality time for my life? So I can spend time with family, friends. I can drive to my parents' house. I can go to the beach. I can go to the the football, and I'm actually going to be about 15, 20 minutes away from that. And if we're looking for those drivers, you're not seeing a lot of new stock coming to the market within there. You're finding these houses are on bigger blocks, they're well looked after, they're well built, and they're located within that proximity to everything that the buyer wants today, as well as what a buyer may want in 5 to 10 years' time.
Every property in a city is going to be obviously related to how the city as a whole performs. So if one city goes up in value 6% per annum, it's unlikely your suburban house is going to go up 14% per annum. It's just not likely. But having said that, if you just we're looking for that outperformer by a couple of percent a year, and that just makes so much difference to their long-term wealth. And you're already seeing it with some of our clients who've made good money on their properties. They come back for second and third times, don't you?
Yep. And when we're making decisions that are based on research, that is also not just research for the last 12 months, but what has performed for the last 1 year, 5 years, 10 years, 20 years, and 30 years, you can actually make a quite good informed decision based on what you know has worked in the past and what's driven that area.
So, Robin, I know at Momentum Wealth, there's an approved suburb list, and that's all the suburbs that our buyers agents are authorised to buy in, and that's not just in Perth, but obviously in other locations around the country as well. But tell me, what goes into becoming an approved suburb to buy in?
We have quite strict criteria at Momentum. We're looking at that past history. We're looking at the locations. We're looking at the zonings. We're looking at future plans for the area. We're looking at infrastructure. We're also looking at risk factors as well. So how can we take advantage of primarily a marketplace that we want to sell to in the future, which is an owner-occupier? We're finding that headline figures are drawing in a lot of investors, and they're coming to us with a pre-framed idea of where I should be buying in Perth. They might pick a suburb, and that suburb is being very largely driven right now by a lot of investors purchasing that suburb. When that investor demand diminishes in the future, which it will, what is the underlying demand for that suburb? And when it's driven so high by one portion of the sector of the market, those areas are quite often the ones that will soften back the most. We're also finding those areas have the most amount of rental properties available. I can give you an example of a client I was just looking for, and they wanted to buy in an area where there is currently only one rental property for lease in that one particular suburb. So not only is that area very much an owner-occupied area now, it's also in demand from tenants because not many investors are purchasing that area, which means it's well located and meets those fundamentals. We're looking at our investment and our Momentum Wealth approved suburbs along the lines of what we've said around infrastructure, location, previous history of growth, which we look back to 30 years. But we're also looking at what are the median price points for houses, for villas, what is the percentage of owner-occupiers in that area, what is the percentage of housing that's owned by social housing, government housing, what is the percentage of rental properties in that area, how many owners have actually paid off their mortgage completely. We're also looking at the census data as well to go who is actually buying in these suburbs, what are their average incomes, how much can they afford to pay for rent, and can that rent foreseeably go up based on the average income of the people who are buying and leasing in these areas. So when we take all that into consideration, we get this excellent blueprint of what we should be doing and where to achieve those results for our clients. We do review this on a regular basis too, because demographics do change in every area. So we do, as a team, talk through this. Our investor committee works through these suburbs as well, and we do propose changes as those demographics change. We also want to advise to our clients that when you're buying an investment property, you're also thinking about the tenancy in that property as well. What are the type of tenants who are going to be in that area? How often will that property sit vacant? How will that property be treated by a tenant? We would much prefer to have a property go to a tenant that stays there comfortably for 5 years, is stable and wants to be there, compared to a property where the tenant moves in and then next year you'll have a new tenant. The year after that, you have a new tenant. You've got move in, you've got move out, you've got bond inspections, you've got more costs. We're trying to get our clients into those areas where they can get stability, safety, certainty, and as little of those risk factors affecting them as possible.
Yeah, and that's great advice, Robin. It is complex to some degree. It's you've got to make that decision to invest, but you've got to invest in those better areas, and it's worth the time and energy to either appoint a buyer's agent, or if you're going to do it yourself, you've got to spend a lot of time and energy, because if you get it right, that 2 or 3% per annum that we're going to try and get for market outperformance can really set you up for life. And we see it, get in the second property, the third, versus someone languishing and stuck in their first property. And it's important and I'm going to talk about emotions in property. The third fundamental rule is buying with your head and not your heart. And we, And we see that, don't we? We see the clients who get a bit emotional, and that's often why they use a buyer's agent. They like to keep that out of it. But fundamentally, buying an investment property, you've got to be open to different cities, different suburbs than you live in. It's about getting the best returns. It's not about buying something that you feel you can drive past on the way home. We know people like to do that, but that's not going to be necessarily the best decision. And we see a lot of people buy so emotionally in property, which is so frustrating because it's such a big investment. It could potentially be $600,000, $700,000, $800,000 or more. And if you get the wrong, as I said earlier, if you get the wrong one and you don't buy in that right area, you underperform, it's going to cost you potentially hundreds of thousands. So we're going to talk about FOMO, which is fear of missing out, and that's what you do see in hot markets. And look, markets go up and down, and sometimes they're hot and sometimes they're cold, and sometimes they're in between. So fear of missing out. So how do you see that with clients, Robin, and at varying stages of the cycle?
We see that all the time. We see this scarcity aspect played by the selling agents very well, that this is the one property, it's the only one that's going to be for sale. And if you don't get this one, I might not get anything else in this marketplace. And this is something, our team follow from your direction, Damian, very well, is every week there'll be another few hundred, there'll be 800, there'll be 1,000 new properties coming to the market in that marketplace that you can still choose from. So we try to, with our clients, remind them that this is a business decision fundamentally, that this property is good, it's well located, it meets all the fundamentals up until a point. Beyond this point, it's starting to get an emotional decision where you're now caught up in the negotiation, you're caught up in the excitement, you're caught up in the process, and then before you know it, you've paid $1,000 more, then it's gone to $2,000, then you paid $10,000, and before you know it, you're $40,000, $50,000 above what you needed to spend. So what we try to do with our clients is create almost the JOMO, which is the joy of missing out. And how we do that is we create the walk away price in our documentation. We'll send it to a client saying, this is how we should approach the negotiation. This is where we should stop for this particular property. Beyond this, we know we've done a job well because we haven't been caught up into that process. But because we document that before we start a negotiation with a client, it gives them that certainty, and it gives us the ability to go back to that client saying, look, we discussed it. It's in the document. We're not paying more than $820,000 for this property. It's okay. We're going to be able to find you more properties. It doesn't have to be just this one. There'll be other excellent opportunities we can uncover for you.
I love that, Jomo. You haven't told me about that one before. I'm going to put that in the next book update, Robin. Thank you for that. Thank you for that tip. That's exactly right. As you said, no matter where you are in Australia, in every major capital city, there's between 500 and 3,000 new properties coming on next week, and the week after, and the week after that. Yes, there might be strong competition. There might be lots of people putting in offers, but there will be the right property for you, and you don't have to overpay. And that's what FOMO often leads to, the overpaying people. And we've seen it. We see properties you guys go up against, and you put in a price, example, 650, and you hear later it's gone for 720. That is sometimes common in the hot markets. Obviously, the markets go in different cycles. But also, I guess, how do you then deal with the FOOP, which is what I call is fear of overpaying? So where people are in a strong market, people are going, I don't want to overpay, but they end up buying nothing. So how do you deal with that, and how do you talk to clients about that?
We remind them in the purchase, and this is before a negotiation, so it's not done at the time that we're going with an offer, but there is an opportunity cost for us in a marketplace that if we see something that is absolutely excellent in almost every category, and we do have to pay maybe $5,000 more to secure that property, in our opinion, that is a well-educated and well-thought-out strategy for this particular one, given the fundamentals of the marketplace. If the marketplace is seeing huge interest, minimal stock levels, and minimal new completions coming to the market, it gives you a bit of certainty to go, well, look, I am prepared to pay a little bit more for this particular property, but I won't pay above and beyond. But the opportunity of cost of doing nothing, and unfortunately, we do get a lot of owner-occupiers come to us, and they are coming to us with, look, I've been looking for 6 months, I'm putting in offers, and I'm not getting anything. What we could have got them 6 months ago compared to what we can get them today, significantly different. So we would encourage the buyers out there to have that plan, not overpay, but also be mindful that in a market where you're scaling up, sometimes you do have to pay a little bit more. In this marketplace where we're operating heavily at the moment, sometimes we do have to pay just a little bit more to secure an excellent property, but we're finding with almost every property that by the time this property settles, which is about 6 to 8 weeks later, the value has already increased by that point of time. So they've already got an equity increase from that. But that's a calculated decision that we make with the buyers to say this is an okay decision for you to make. What we find is the emotional side is what pushes people above and beyond that educated decision, and we walk away from properties where someone's, $50,000, $60,000 above what we think is fair and reasonable. Excellent for the seller, not great for our buyer, and we've already walked away at that point.
I think it's adjusting all these emotional reactions to property. It's about where the cycle is, right? So in a hot market and people have that FOMO, the fear of missing out, and then they end up overpaying for something. And then you get FOOP, which is fear of overpaying, and then people end up, though, get so reluctant to make offers or to put them in the market, they end up buying nothing. And as you said, 6 months later, then they finally wise up to where the market is, they've missed out on potentially $50,000 or $100,000 of capital growth. And look, you've got to adjust your market strategy to the market you're in. So in a cold market and a soft market where there's lots of stock around and lots of properties, it's going to take on average potentially 6 weeks, 8 weeks, 9 weeks to sell a property, and you're spoiled for choice. You can lowball. You can go in with pretty tough purchase conditions that favour you. That's okay in a soft market. But when you're in a stronger market or a hot market, well, there's no point playing funny games and trying to lowball, because there'll be 3 or 4 offers above you. You won't even get a second chance. You won't get a look in. And I think that's the thing, that's the educational piece that obviously you do with the clients, but also for people out there who want to do it on their own, you've got to adjust your strategy to the market. If you're in a cold market, which markets go in all different cycles around the country at different times, if you're in a cold market, you can be more aggressive, lowball, tough conditions that work for you as the buyer. But if you're in a hot market, if you play those games, you might never get anything. And but always keep in mind, as we said earlier, there will be more properties next week and the week after, and the right property will be there. It shouldn't take you 6 months. If it's taking you 6 months, there's something incredibly wrong, but you don't have to buy it the first week you see it. And you've got some time, but you don't want to wait certainly 6 months, particularly in those strong markets. So, Robin, look, the other one is what I call effectively buyer's remorse, fear of better options, where people look at a property, they buy it, and it's a big investment decision. Do you ever get clients with that, there could have been a better offer out there, could have been a better property for me next week? They start to get buyer's remorse. Do you see that?
Very common human emotion.
Yeah,
everyone experiences it, and it's our job as buyers agents to remind them of the fundamentals of what they've purchased and why. We do that quite extensively through our due diligence process as well, reminding the buyers of what they've purchased, why we actually met their goals with that particular style of property, what it is worth in the marketplace. They know they haven't overpaid for the property, otherwise they wouldn't have secured it with us. But also that this is what they've done as part of a 10, 20, 30-year journey, that regardless of what happens in the marketplace over the next 1 year, over the next 30 years, even the worst underperforming suburbs potentially can still go up 400-500% over that time. So we're not looking to achieve lower returns for our clients, but we're saying that no matter what you do, if you buy a well-located property in a good area, you're going to do excellent over the long term. If you're buying something in a exceptional area or one of our Momentum Wealth approved suburbs, those have the track record of outperforming the marketplace. So when you go and sell that property in 20 years' time, it's a much better return than you could have got had you have just bought anything on the market or responded to the hot suburb on the news. There was recently 2 suburbs identified. Both of them are in areas that we would not be purchasing in, but they've achieved such significant growth that all of a sudden all these more investors are going to go to this marketplace, pump it up artificially, and it's going to actually suffer once the market cools down a bit. So not responding to the headline figure on yield, not responding to the headline figure on capital growth, but looking at how this suburb has performed over the long term and how it meets your goals, not just for yield, but also for capital growth, or not just for capital growth, but maybe you want to blend. So what am I looking to achieve, and how has this property done it? If we do that well through our clients through the process, we do experience that buyer's remorse, but it's negligible.
And look, that's important, isn't it? We're looking for those properties that are going to outperform for the next 10 years, 15 years, not just what's the hot suburb now that's going to go up next week. It makes you feel good when you buy a property and 3 months later it's up a bit of money. But if it's not the best property for the next 10 years, well, you're going to suffer in the long run. So that's a really good point. Thanks, Robin. The 3 fundamental rules you need to know before investing in property, and they're what we covered today. Firstly, that land appreciates and buildings depreciate. Doesn't mean you don't buy apartments. What it does mean is that you need to understand what you're getting. You want to make sure you're getting a decent land component value compared to your budget, because that's what's going to go up in value while the buildings will fall away over time. The second one, look for areas of high demand but limited supply. Don't get sucked into buying in these growth areas where there's lots of population growth. And the reason is that's because there's lots of land and more people can move to that area. We've seen it happen time and time again. Those suburbs get oversupplied, and when the downturn hits, they get hit hard. So buying established areas, good demand, lots of things going for it, lots of potentially new things happening, but it's got limited supply. And that was what will force your prices up. And importantly, buy with your head and not your heart. Keep the emotion out of it. If it helps, use a buyer's agent, because a lot of people do. That help keep that emotion out of it. But you've got to buy with your head. It's an investment property, and ultimately, if you make those right investment decisions, you'll make a lot more money. Don't overpay, but don't sit on the sidelines and have this fear of overpaying, because you'll never end up buying anything at all. Thanks, Robin, for being here. A great episode. Really appreciate you coming on.
No worries, and also a bit of fun talking about FOMO, JOMO, and FOOP, a new term I learned today as well.
I'm going to use JOMO. That's a good one. Love that one. Thanks, Robin, and look forward to the next episode. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest. Today's guests are representatives of Momentum Wealth Property Advisory Proprietary Limited, licensed real estate and business agent in WA, RA 82976.